Hey traders, this is Blake Morrow with Traders Summit, and I get to bring on a very, very good guest that I haven't had on for a while. I'm bringing in Deer Point Macro. Good to see you, kind of.
Yeah, thank you so much, Blake. It's always a pleasure to be on.
Yeah, it's a pleasure to have you here. And I want to say that I guess before we get started, congratulations are in order. You're at now one of the largest asset managers in the world.
Yeah, thank you so much. It's been great. Busy, but it's been great, keeping me on my toes.
Oh, awesome. Well, it's great to have you here, and I know we actually have a lot to talk about because you happen to be located in Canada, and I wanted to pick your brain about the Canadian economy. But more importantly, next week we have a lot of central banks meeting. We like to say it's the central bank bonanza week, if you will, with so many central banks in the spotlight. What are your thoughts as we head into next week?
Yeah, I mean, there's kind of a lot on the table now in terms of like what central banks are doing. And we're kind of seeing this ending of the synchronized hiking cycle. Obviously, a lot of banks are now starting to come out and cut. Kind of just namely off the top of my head, you obviously have the central bank down in Brazil that's now essentially said that they'll cut 50 basis points continuously until something changes. You had the Czech central bank come out. You had Poland. So, I do think that now we're going to start to see a lot of central banks saying, just given kind of overall growth prospects, kind of with the US being the outlier, a lot of economies slowing. And so I think now this is a time where a lot of central banks are going to have to go and look at where monetary policy is and see if now it's time to start adjusting things gradually, not saying that necessarily go back to ZERP, but kind of this gradual readjustment to kind of give some momentum to the economies across the world as, things start to slow down, kind of coming out of that pandemic boost.
So, you mentioned as, excluding the US, we do have central banks like the ECB. We have the Norges Central Bank, Banxico, Bank of England next week, Bank of Japan. And I love this topic of conversation because it seems like all central banks have moved higher in unison up until recently. Now you're starting to see the divergences between central bank monetary policy between different countries and economies, and that's what creates volatility for us as traders. So, what central banks are you looking into next week that are biggest risk of perhaps maybe a rate cut?
Yeah, I mean, I think that the possibility for the for the ECB is definitely there. I think right now, kind of looking at OIS, overnight index swaps, I think the market's pricing about 105 basis points of cuts for the ECB. And kind of last meeting, Lagarde kind of gave like this very nuanced, opinion in the sense that she kind of contradicted herself. On the one hand, she was like, we're not thinking about cutting rates. And then I think it was like 3 or 4 paragraphs later where she was like, now it's time for us to readjust and start to think about easing monetary policy. So like almost in the same speech, on the one hand, she's like, no, we're not thinking about it. But then she's on the other hand, like we're thinking about it. So, I think that if you're starting to look at the ECB, they are going to have to start to ease monetary policy given kind of overall growth has been very weak. Germany slowing materially. But the ECB is always a kind of an interesting one as well, because on top of managing monetary policy, they have to manage, kind of look at the overall fiscal landscape. But because there's no centralized fiscal authority, every nation on its own is kind of off doing its own thing. So that's
Right.
something that they have to take into respect. But I also think that the BOJ, not in terms of rate cuts, but actually leaving and starting to hike rates as the curve's now pricing in that they will start to raise rates in March. It's also going to be interesting from an FX perspective because obviously the yen has been very weak. And so it should be very interesting now to kind of see if they start to raise rates, if, differentials, the difference between the US rate and the Japanese rate will start to kind of tighten somewhat and start to, give the yen a little bit of strength, going into the remainder of the year.
Yeah, no, just for clarity, the ECB doesn't meet next week, but they meet on April 11th. So we got a little bit of time before we have to deal with them. But when you look at some of these central banks, as you mentioned in LATAM, that are starting to cut rates, Banxico seems to be on the chopping block right now, where they might indeed start cutting rates as well. Do you think Banxico is heading down that path?
I think that they're heading down that path. And actually, the interesting thing, even if you were looking at FX yesterday, and I'll see if I can pull this up just to get the exact percentage changes. But obviously, we started to get positive news out of the US, and that gave some strength to the dollar. And Latin American countries actually started selling off. I believe, off the top of my head, I think it was like the peso, the Brazilian real, Peru, a lot of these Latin American countries actually started to see slight sell-offs against the dollar and actually started weakening against the dollar, just given the backdrop of US data that we're getting that continues to kind of surprise to the upside. So I think that a lot of those guys are going to end up starting to ease. And obviously, even now we're starting to see Mexico slow. I believe their recent GDP figure was down slightly, and I'll get that pulled up. I think it was kind of going back in line with kind of where it's been growing on trend, for the last couple of months. So I think it's around like 2.5%, 2.4%. And that's down from from Q3 2023 that was growing at 3.5, and then as of Q4 2023 it's growing at 2.3. So dropped about 100 basis points since the previous quarter. So obviously we are seeing growth start to normalize or even weaken in Mexico as well. And so I do think that they're going to start to readjust monetary policy.
So you mentioned about the U.S. being more surprisingly better data, and it sounds like when you say surprisingly, it's surprising to you as well. That the U.S. economy continues to be as resilient as it is. How long do you expect that to persist? The U.S. exceptionalism. I'm sorry, I should clarify that.
I mean, I think that it's been something that surprised a lot of people, right? Because if you're kind of looking back at last year, obviously, kind of one of the loudest calls was this recession call, but you continued to get data, right? So like, if where you're kind of looking at, obviously GDP data was coming in extremely hot. You had labor productivity data coming in very hot. You had, gross fixed capital formation, kind of just investment, is a fancy way to say investments in like plants, machinery, equipment coming in hot. And so you had, this rapid kind of wage growth that a lot of people were looking at, saying that obviously this is going to give, kind of a boost to the consumer to go out and continue consumption. And so, when I'm kind of looking at the US, I don't see as of current any sort of slowdown because, Yellen has kind of taken over, kind of replaced the importance of Powell. And obviously, I think right now, fiscal spending as a percentage of like its contribution to GDP is adding about 90 or 100 basis points to GDP, if I remember off the top of my head. And some of that is actually going into the real economy, not just, financialization. And so I think that that's giving this massive boost to the US that's going to continue to kind of allow it to chug along. And I don't see, if you were to have to say a recession call or some sort of slowing in the business cycle, I would probably say if a gun to my head, you probably wouldn't see that until most likely the second half of next year. But again, recession calls are very hard to kind of make. But, the way that I kind of look at this is I look at all the economic data that's coming out, looking at expectations, what kind of consensus forecasts relative to where that number actually comes in, and it continues to surprise to the upside. So actually beating out consensus expectations. And so I think that that's why, one, the market's kind of pricing higher for longer for the Fed, but also two, why you're having kind of a lot of volatility in overall rates markets as things continue to readjust, because you get I will say you get, good data, but then you get things like payrolls or the unemployment data that went from 3.7 to 3.9. And the market's like, oh, the bears come out. Oh, this is it. The recession's here, And so I think that people are just trying to really nail down where we are in this business cycle. And I think that it's been very, very confusing. But I do think the US is going to continue strong through the rest of the year.
Well, it's been a fool's errand as far as this goes. Now you live in Canada. I live in the U.S. You made mention to me that there's the Canadian economy is starting to weaken. How's that going to show up? How stark of a difference do we have between what's happening in Canada and what's happening in the U.S., being that you're just our neighbors to the north?
Yeah, I mean the difference is very surprising. Even now, if you're to look at unemployment data, and obviously there's a difference in the calculation. The US starts calculating unemployment at 16, Canada calculates at 15. So this is kind of important to take into consideration. But nevertheless, right now, the unemployment rate in Canada, I think, is around 5.9%. And it continues to kind of tick higher, and the labor market continues to loosen. And so, really the problem with Canada has been this aspect of financialization, where they've kind of moved away from real economic investment. And Canada's economy is almost like China's now, in the sense that like 25% of GDP comes from some aspect of the real estate sector. And, after everything with the oil and gas, and obviously, the current government, without getting too political, and Canada is obviously not a fan of oil and gas, and it's kind of, really put the red tape around those guys. There hasn't been a lot of other places for people to put their money to kind of, generate some sort of ROI. And even if you look at the TSX, most of that is essentially the FIRE sector. Banks and insurers are kind of the large contribution, and then everything else is like oil and gas, and then like tiny mining stocks, right? So, even from that aspect, I mean, being like the TSX has massively underperformed the SPX, the S&P 500. So why would you even put your money in Canada when you could just put it in the US? And so that's just essentially continued to pile money into the real estate sector, but the rest of the economy is not actually feeling that. So you have very bad labor productivity numbers. GDP per capita, I think, has been contracting every quarter now, off the top of my head, if I remember correctly, for the last 6 quarters. And so like you've had this stagnation in the standard of living. I think that the Canadian aspect is much, much more stark than that of the US, and you're already seeing GDP slow, where right now, let me see, I think the most recent figure for GDP for Canada is coming in. Let me just check it just so I can get the exact quote here. The most recent kind of growth rate on a month-over-month basis, because Canada actually does it on a month-over-month, came in at 0. So that probably means like overall annualized GDP is probably going to come in around like 1.4% for Canada. So obviously about half of what the US is doing currently, right? So much slower. And so I think that now the Bank of Canada is obviously going to have to start to readjust policy. And finally, the other aspect that's very important is the entire Canadian economy is essentially tied and is essentially very interest rate sensitive, right? Because in Canada, you don't have a 5-year or 30-year fixed mortgage. Like the majority are 5-year fixed or 5-year variable. So every 5 years, you have to go and renew your mortgage at a different rate. So even that in and of itself is causing a lot of stress, where people had trigger payments. We now have negative amortizations, which means people aren't paying any of the principal, they're only paying the interest. And like now I've seen amortizations up to 90 years on some of these mortgages now.
Wow.
Just to keep the payment the same. So much more stark, because just the level of interest rate sensitivity. I do think the Bank of Canada is going to have to readjust. And even if you start to look at the forward curve, like US compared to Canada, Canada is kind of the expectation is for them to start cutting about 6 cuts. And I think right now expectation for the US is 4. So much more cuts than the US currently priced in.
So where do you see the majority of the FX positioning and where should traders be positioned based on your expectations of a slower rest of the world to the US? Should everybody just be long dollars? I mean, is that the true play right now?
Yeah, I mean, I was very surprised because kind of going into the beginning of this year, I thought that you were going to have things start to normalize from an FX perspective. And I know everybody just kind of likes the Dixie, even though I like to kind of look at things on a pair-to-pair basis. But the Dixie's just kind of like a good aggregate measure of dollar strength. That a lot of people are familiar with. And I mean, right now, it's probably, I think it was in the 103s, right? Something around there. And so, I mean, like, I just given kind of where we started the beginning of the year, yeah, 103.46. I did not expect the Dixie to continue to be this high. I kind of expected it to start this gradual decline down to like about the mid 90s. And we've been much stronger than that. And I think largely a function of that is this amount of economic dispersion, right? Where the US continues to surprise to the upside. Everyone else essentially globally continues to surprise to the downside. Canada is actually surprising to the downside relative to consensus expectation. I put something up on my Twitter on that yesterday, where, maybe let's say, a data point set at 0.5 and it comes in at 0.2. So things like that are continuously happening in Canada. Things like that are happening in Europe. And so I think when people are kind of allocating capital, everywhere else is slowing and the US is kind of continuing to be that safe haven. And I think that it's kind of pushing people, flows overall into the US. And even from an equity perspective, what was very interesting was I was looking at flows yesterday. All the flows that we're now seeing are essentially flows into the real economy. So consumer staples, industrials, communication services, manufacturing, all of those kind of sectors, utilities are all actually now seeing inflows. Whereas like things like tech, things like even some financials obviously are starting to see outflows. And so I think now you're starting to see this kind of move away from financialization where people are looking at the US economy saying, wow, they're actually generating real growth in the real economy, no longer the financial economy, and flows are starting to find their way into there. So I just think that the US is going to continue to kind of be a beast. And, I would say now, even from an FX perspective, that's probably something that you don't want to fade or try to get in front of, right?
Yeah.
On the other way.
I mean,
So
based on what you've told me thus far, or told us this far, it does feel to me that you are really more bullish on the U.S. economy, bearish on every other economy for all sorts of reasons, but and that central banks are going to have to make adjustments, and you're going to start to see cuts everywhere. But let me real quick before we wrap this up, what other economies do you feel is there, or are there any, like maybe the UK economy or something like that has stubborn inflation where they're not going to be able to move rates? Are there any other economies out there that you think they are going to have to keep higher for longer other than the US?
yeah, I mean, the question then becomes like they get in this very tricky situation, right? Where it's like the economy is now slowing if you were to look at places like the UK, but you're still having very stubborn inflation. So it's like, what do you do? Do you let the economy slow and then try to have the business cycle pull inflation down? That is like obviously one aspect, but I think at some point they're probably going to end up digesting higher inflation rates. Like even in the US, we might just start to digest the idea of being around 3.5 or 3%, for the intermedium. And I think that a lot of nations are going to have to do that. And they're just going to end up having to cut rates to kind of stabilize overall economic policy. Because when I'm kind of looking at the inflation that we're getting, I me personally, I don't think that it's as driven by demand as it was by supply. And the fact that a lot of nations, they just, one, have never, like over the, essentially since 2008, weren't investing in building out like the supply side. They were just invested in kind of trying to curb demand. And thus, that part of the economy has been extremely underinvested. And so you can never really have, a level in which, and that would take a couple of years, where supply can actually increase enough to start to meet demand both domestically and obviously kind of internationally. So I do think that a lot of people are just going to have to end up digesting that. But I do even think that if you're kind of looking at even FX aspects, I do think that there's still continual areas in which are very attractive. I know that this might be a little bit wild, but I'm actually starting to think that the Turkish lira actually might start to get some momentum relative to the dollar, because now obviously they've tightened monetary policy tremendously. They're actually now starting to soak up. They do something where they essentially they're kind of soaking up the supply. They call it sterilization of Turkish lira in the economy. And I do think that actually might give some strength to the Turkish lira.
Wow, just looking at the chart here, I'm not sure I want to stand in front of that, but you first.
Yeah, exactly. I was actually talking with a guy who runs he's a emerging market PM. I kind of pitched the idea to him, and he's like, I mean, it's not too crazy, but it's, will it work is kind of the question. And then obviously, there's everything going on with the Egyptian pound, which I do think will start to stabilize. Obviously, now they're starting to get, foreign direct investment, mostly from people in the region, the Saudis and the Emiratis. Yeah, I do think that one might strengthen somewhat. Even now, if you're kind of looking at forward, like a kind of forward versus spot, it's now starting to regain some momentum from that massive, 40% drawdown that it had. I think that's about 40%, something around there. Yeah. So now that's starting
a big one.
Yeah, starting to strengthen a little bit, but obviously those are going to be much more risky. And obviously, you need to hedge that, specifically, left tail risk hedging, where you could get another drawdown when you're trying to play, some sort of momentum back in these currencies. But yeah, I mean, that's how I think that it's going to continue to be. And I actually think that now long dollar against the euro is also going to be attractive, because you've kind of been range bound between like 104 and 107. And I do think that if the ECB starts to normalize policy in April, then by starting to slowly back off and start to cut rates, I do think that the US will start to strengthen relative to the euro, and it'll kind of break this kind of sideways choppiness that it's been in for, the last couple of quarters.
So. And what you were just quoting is the dollar, the Dixie, where the euro is trading between 107 and 110. You're saying that the euro could be trading back down below 107 and the dollar index back above 107.
Yeah, exactly.
Okay.
Yeah.
Well, I want to say, Deer Point Macro, you're one of my more recent, I say recent, over the last 2 years that I followed on Twitter. I really enjoy your content that you put out there. For everybody else, is this the best way to follow your work?
Yeah, they can follow me there, and then obviously I have the Substack, but just given work now, I haven't had time to do much writing there. Whereas Twitter is just kind of easier to do like quick posts on.
Right.
Yeah.
Just what's off the top of your head. And so following you, Deer Point Macro on Twitter, or better known as, or also known as X, is the best place to follow your work.
Yes, exactly. Yeah.
Well, guys and gals, if you enjoyed this interview, make sure you give Deer Point Macro a big thumbs up, and comment down below if you feel that there's another economy out there that might outpace the U.S. economy, or you think the U.S. economy is about ready to poop the bed. jump in the comments below and let us know. And also give them a big thumbs up and subscribe to the channel so you don't miss any of this exclusive content. You know, Dear Point, next time I have you on, I'd like to pick your brain about China. I know you deep dive into China from time to time, and I want to know maybe the next time I have you on if they're going to make a turn, or
Yeah.
or will.
Yeah, that's been the big question. Yeah, that would be great.
All right. Well, thanks for being with us today here on the Traders Summit, and I'll look forward towards our next conversation.
Yeah, me as well. Thank you, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.